Solutions series. Today is the second program of this new online briefing. After each program, you'll take away strategies and tactics that are positive and practical, as well as honest and realistic. My name is Sheila Vertino, and I'll be your host for this program. Our topic today is, what can we learn from past downturns? To find out, we have invited Aaron Paris to be our guest. A seasoned developer with 30-plus years of experience, Aaron Paris has survived several past downturns in the industry. And he's going to share with us some war stories, some lessons learned, and other near-death experiences from the tumultuous early 90s. Plus, he has some suggestions about how to beat this current downturn, too. Aaron heads Paris Development II, a firm that specializes in the acquisition and development of industrial buildings and parks in major logistics markets, with financing from a private investment fund. He brings a unique perspective to our discussions today as a result of his wide-ranging career. He's held executive positions with DP Partners, Tooley Company, Trammell Crow Company, and Metropolitan Structures, MetLife's financial partner. Aaron is based in Chicago and is a member of the NAIOP Chicago chapter. At the end of my conversation with Aaron, we'll have a Q&A period. And if you have a question, just type it in during the interview, and we'll answer as many questions as we can during the last 10 minutes of the program. Aaron, I'm sure everyone is eager to get started. And maybe the best place to start is with you telling us a bit about your career path, especially what it was like during the early 1990s.
Okay, well, good afternoon. I'll do my career path basically in order of downturns. I think that's sort of the best way to do it since we're talking about those. I was at Kellogg Graduate School of Management during the oil embargo of '73 and went on to work with Coopers & Lybrand during that recession. But after that, I was strictly in real estate. And during the '81, '82, I'm going to jump a few years here, I had to go back to Cleveland, Ohio, and assist my father, who had a heart attack in Paris Development. That's Paris Development 1. And it was an interesting lesson. He was a sole proprietor. He worked in only one market, and he was basically a land developer, residential, industrial, and office. He also partnered in suburban office building and industrial flex building. His model for success was knowing the great locations within a very small market, just the Cleveland market, knowing all the political players, the lawyers, engineers, development partners. And he was the ultimate outsourcer in keeping his overhead low. And again, very, very successful. For the recession of January 80 to 780, 81, 82, 90 to 91, I was with Metropolitan Structures, both here in Chicago, Montreal, and in Los Angeles. To my good fortune, they offered me positions, and I moved to other great cities. Metropolitan Structures was a CBD office developer, major high-rise office buildings in downtown markets. The interesting transitions we had to make was being basically a tax shelter, privately owned tax shelter-driven partnerships to an institutional partner in the 1980s, and some of the effects and benefits of that came out of the '86 tax change. Again, we were product unique in high-rise office buildings and CBD markets. Extremely savvy company financially. After the 90-91 recession, I joined Tooley Company in Los Angeles. We were CBD, again, suburban CBD office developers, suburban meaning out on Wilshire Boulevard and the different downtown markets that they have. We acquired, while I was there, the Water Gardens, the Twin Towers, and Century City, and our goal was to look at becoming a REIT in 1996, or when the REITs really took off. We had an opportunity to sell our assets or upreit our assets into a REIT and to sell our management company for very, very good numbers. So we decided instead of becoming a REIT ourselves, we would sell ourselves to others. Key thing about this company was premier client, tenant, and real estate owner relation manager. They were the best at that. For the recession of 301 to 1101, the dot-com bust. I was with Dermody Properties. I was with them for 9 years. Again, the key part about this company is we were product unique, market diversified. We went national as an industrial developer. We had a distinct strategy how to go national, very systematic. Again, extremely tenant focused was our key. And the other key strength of this company were our institutional partners, which we'll talk about a little later. But those are basically my career path. So I've done office, industrial, a little bit of retail, none of it successfully, and residential.
Well, that certainly is a varied experience. So there were a lot of downturns there, and what do you think are some of the similarities or the differences? And looking at what the companies did to stay in business then, is there anything we can apply to staying in business now?
Sure. I mean, again, some framework in the early 1980s, and when I talk about recession, I'm talking from the peak to the trough, not necessarily how long it took to get out of the trough, because in our industry it took an extremely long time. But in the early 80s there were two recessions, one in January 80 to July 80, and again from July 81 to November 82, which is the 16-month recession people think about or talk about. What was key that went on at that point is interest rates were very, very high. And inflation, they were getting higher, I should say. Inflation was the real nemesis that the Federal Reserve had decided it wanted to squeeze out of the economy. They shrunk money supply. Back then, money supply really meant something because you didn't have all these exotic cash forms of investments. So money supply was a big item in the Fed fund rate. They pushed that from about 11% in '79 to 20% a year later, and they drove prime rate up to 22%. But as that as a background, and it was very distinctly remember in '83, people were saying New York City was dead, never going to come back again as a financial center in the United States. Obviously, that's not true. It's interesting you hear the same thing today, that Wall Street has moved to Washington, D.C. I don't believe it, and I don't think New York City is dead at all. But similarities, growing deficit. We had banks that we thought were too big to fail. The classic was Continental Bank. Again, some of the differences that are important is it was loans were available, even though loans they were 13, 15, 16% interest. You could get loans, especially from the insurance companies at that point. Unlike today, where it's virtually impossible to get a loan. And the lenders it was a limited group of lenders. You didn't have the exotic lenders as you have today. They were basically the banks, the insurance companies, and savings and loans. So you had very much relationship with your lenders. Now, what did we do to stay in business? I mean, the key change we made in the 1980s was to become partners with a solid financial institution, become an institutional partnership with Metropolitan Life. It was very important for us. It gave us a lot of credibility. It gave us the ability to compete against the Canadian developers who had been coming down to the United States. It added an ability to obtain loans both from the financial institution partner and elsewhere. So that was a key change we made. Other things, we stayed at MetStructure, single product focus, and I'm a big proponent of that. If you're going to go on try to be a national player, to do every product is I think a prescription for suicide. But we focus on long-term investments, and obviously the tax law change of '86 was a significant change to that strategy, and I will touch on that a little later. The one recession we talk about often is the one in 1990. The recession peak to trough is really 790 to 391. This, many people refer to it as the savings and loan disaster. That was the key event that went on. There were many key events that led up to it. Multiple small, subtle changes in tax code, in basically deregulation of investments for savings and loans that happened in 1980 and 82, which led up to the collapse in 90. Basically what you saw, let's talk similarities, and is the reduction in regulations. Savings and loans were basically deregulated. Their deposits were, and they had the best of all worlds. Their deposits were fully insured. They had increased deposit insurance from $40,000 to $100,000, but there was no regulation on federal savings and loan, very little regulation as to their investment. Before 1990, there was a flood of foreign money into the market, which sounds the same as the late 07, 08 period. There was a flood of foreign money, mainly Japanese. At that point, if you recall, people were afraid the Japanese were going to own all the real estate in the United States. But that never came to be. Money was available from new sources at this point. Really, this was the transition to, this period was the transition from insurance, banks, obviously savings and loans disappeared, to the birth of REITs. So that was a big difference. One of the other similarities, what was happening in that period that made it so crushing, was the lenders were insisting on rebalancing of loans. In other words, equity had to be put up to get the loan in balance, or we call it today maturity defaults. That was the main drivers. At Metropolitan Structures, we looked at that and said, no, we don't need to do that. And we put up money or put good money at the bed at that point, and we let the banks take them back. Business slowed dramatically back then, as it has today. Real estate values plummeted back in 1998. Probably fell 30% in the 92, 93 time frame. They were probably, real estate had the same value in the early 90s as they had in the 80s. Again, I'm not going to touch on a lot of the differences, but what did we do? And during this recession, we really focused on generating cash flow. We created a very successful property management company, which also did owner's rep leasing, and we moved into Orange County, Boston, San Diego. Never really had the opportunity to take advantage of the insights we gained because we sold that company to Cushman & Wakefield. We eliminated our construction company early in the 90s. We had, and this is probably my worst day in real estate, is we fired and or laid off, reduced staff, trying to come up with a nice term, over 200 people in one day. We had an extremely successful general contracting arm, but we had to eliminate it since there was no more work. We also had to eliminate a lot of very senior positions. As people recall, in 1990 they were saying stay alive to 95. Little did we know you had to stay alive a little longer. And we looked around and said, who we are today is not what we want to be 3-4 years from now. And we really bit the bullet and gave a very nice severance plan, retired some very senior people so we could refocus our company. We beefed up the junior analysts because they were really going to be the source of good information, and we became big-time asset managers for others, so it helped to have that group. One other strategy we put in place that was very beneficial, even though we were returning properties to lenders, we tried very, very hard to maintain a positive relationship with those same lenders and other lenders, because in fact, as we were giving back properties, we were obtaining from the same players property management opportunities because of the quality of the people we had, not necessarily the negative because of the financial situations we were facing. I think that's about my answer for that.
Okay, well, that's quite the roller coaster ride. So,
Yes.
looking at what happened before, what kind of strategies do you think that people used successfully in past recessions might work again this time?
Okay, yeah, that's a good question. Well, first I should give you sort of my view of what we're facing, and that would give you context to what my recommendations are. My belief is we'll hit bottom. This is, again, trough to bottom of the recession, I believe, this summer, somewhere around July. But if this does not spell immediate relief for the real estate market, I would expect the depression, recession for the industrial side of our business to last another 30 months thereafter. Perhaps in the better, more key logistics markets, that will last another 2 years from July. From the more secondary, tertiary markets, maybe that's 2.5 to 3 years. Office building, I don't see the office market and returning to, and this, when I say return, I mean return to a point where you could consider starting to do speculative development. I would not see that happening for a good 3 years from now. A couple things that sort of color that thought is pricing of industrial and office properties. I think we're going to see from its peak of 1.5 years ago a reduction of probably 35% in the value just because of the change in financing. I think you'll see another reduction in value of 10 to 15% because of the overall economics, the overall slowing economy. So if industrial properties were worth $50 2 years ago, my bet is when we get to the bottom of all of this, that those same properties will be worth $25 a square foot, which is a substantial reduction. I also believe that in 7 to 10 years from now, we're going to see a 1980 style inflation. One of the ways we're solving the mess we're in now is we're going to inflate our way out of it, and thus we'll have to stop the inflation 10 years from now, 12 years from now. So as you walk through an 8-year plan, I would expect that to happen. What to do? With that as background, what to do? I think the first thing anybody has to focus on is improving cash flow and to build for the future. I truly believe property management is a great way to go. I know it's always hard because every developer becomes a property manager. How many property managers do you need? You'd be surprised how many people need help with their real estate. But my recommendation when you get into property management is to focus on markets you want to be in 3 years from now, not just where you are today. And when I say property management, I also mean owner's rep leasing, construction management, all of those things go with it, but with a focus toward where you want to be. If you are in Atlanta and you feel Savannah is the place to be, and you're not there yet, I would buy an existing small management company there, partner with a small management company there. Try to get a base of operations so you have eyes and ears in that market, which gives you all types of information, especially gives you an ability to stay close to new tenants and your own tenants. It's an opportunity to bring great staff, good staff on board. If you can generate business, you can bring on good staff. And if you can find the appropriate clients to work for, you can start creating that relationship with financial partners that could exist after this recession is over. My second recommendation is reduce operating costs. In other words, make sure your organization is structured for the business you want to be in 3 to 5 years from now, not the business you're in today. I also recommend investing in technology to reduce your cost. Video conferencing to reduce travel is a simple example of a way technology can help you. And also, interesting enough of the major financial players have video conferencing. It's a great way to have conversations with them. For staffing, for young staffing to get arms and legs, I'd look to top flight young MBAs, engineers, and other business people, those coming out of who may be laid off from some of the big brand marketing companies, as a way to find people to start training. Again, I'm a big believer in good times and in bad of an outsourcing. I don't think the cycles in our business are so severe, and they happen so consistently that big organizations are very hard to deal with in our type of business. For example, I truly believe hiring outside third-party general contractors, as opposed to, as Metropolitan Structures did, having its own general contracting firm. Because I'm always amazed for a 3% to 5% fee to a general contractor, the amount of risk they take. They'll give you completion guarantees, which is a guarantee you may have to give to a bank. So you get backup to your own guarantees that you may have to give. And they take tremendous amount of risk. The other things they bring to you is innovation. There's not a great contractor out there who can't do all the green innovations to bring your building to silver or any other level of leads you want to succeed at, and at little cost. I remember a few short years ago they used to tell us, oh, you had to hire a consultant, and it's going to cost you $250,000, and I'll look at it and say, well, that's $1 a square foot of a building for a 250,000 square foot industrial. That's hardly worth it. Today you don't have to pay a cent for it. You didn't have to pay a cent for it back then, but those consultants who told you you needed it were the only guys getting paid. But and it's also, hiring outsourced parties is a great source for leads. Contractors get leads, architects, engineers, they all find out what to do, what's going on. Next, I would say talk to your lenders, especially for properties in trouble, and anything that's maturing over the next 18 months, whether you believe it or not, is in trouble. And it is time to talk to your lenders now, start those discussions, start those relationships. And for many of the bigger loans, finding who your lender is could be a real challenge. So I would not wait to do that. I would start that process and see if you can find middle grounds in all the things that are going on. Find a win-win for everybody. The other thing I would recommend is for properties that don't fit in your long-range plans, don't try to rescue. Don't put your money in those deals if you don't have to. Sell them, get rid of them, move them out, and just don't stick with something that doesn't work in the future. I know I'm going on a long time. I'll take another minute. I'd say work on morale. Morale in your company is probably the most important things. Training, training your staff, but also forcing your staff to generate ideas how to succeed. And training doesn't have to be expensive. I mean, these conversations, you could force your young staff to listen to an old man like me, and they might learn something new. Not much, but they'll learn something new. And they don't have to be expensive, but it's a great way to train and to create a positive morale. I'm going to take one long minute to talk about one thing. One of the things we did at DP Partners is we created a knowledge committee, and they were responsible for reading all the industrial literature, NAIOP's Development Magazine, the Journal of Commerce, Business Week, so on and so forth. And they were required to report, write sort of book reports or mini reviews of articles and send the pertinent sections of articles to everybody else so that we all learned what was going on, not in only our business, but this was an industrial company, so we learned about shipping and logistics and companies that were growing and shrinking. For example, they would, in this week's edition of Business Week, they talk about American Eagle and Chico's as being retailers that should succeed in the future. Well, they would pass that article around, and people would say, who knows them? Where are their stores? Where's their warehouses? How do we get involved with them? Others would read the magazines to understand the cost of shipping. Is it going up? Is it going down? Is there more activity, less activity? Institute of Supply Management, Index of Manufacturing Activity. They read all this and reported on it. Next recommendation, financial partner. Start working on putting together a financial partner for the future. You can do that by going to the key players with one-off projects. They won't give you a platform deal today, but they will look at great one-off projects. When you find that project, find the right partner, and hopefully one you can grow with. Get close to your tenants is always important. My big belief is over the next 2 years and over the future, being a little longer time frame, being entrepreneurial. Like my father was in Cleveland, he knew every piece of land in Cleveland. He could buy a good piece of land for a gas station as well as a great piece of land for a residential development. And he had a lot of eyes and ears out there. People would lead him to good pieces of property. Land that sat behind a bunch of houses that nobody knew about. He knew about. And it takes a local entrepreneur to do that. And I would highly recommend, if you're a regional or a national firm, to create those regional entrepreneurs to do multiple types of business for you, which is a little diversion from what I said, being product unique, market diversified. This strategy says, I'm going to be an entrepreneur, in other words, 2, 3, 4 people of great entrepreneurial skills in an office that can bring me opportunities. Again, on marketing, I'm a big believer in branding building, branding the company, something everybody should look at to make sure you have a brand that people can look at and understand. And I'll close this one question you've asked with a quote from Peter Drucker. And Peter Drucker once said, if you weren't already in this business, would you enter it today? And if the answer is no, what are you going to do about it? And I think that applies to everybody, to look at every piece of their business. And is it one you plan to be in? And if you're in it, how are you going to get out of it if you don't like it? That was a very long answer to your short question.
But it was a great answer. It was a really great answer. So my next question to you, that old joke about is that a light at the end of the tunnel or is it a locomotive coming right at us? What do you think about when the light finally appeared in past downturns, and how did you recognize it, and how can you put yourself in the best position to survive and thrive as the markets eventually turn positive? And then kind of a corollary to that is, do you see a sense of the timeline, from the start of the current downturn through all the chaos and trouble to the new opportunity? So I guess the question is, how patient do we have to be?
I gave a little bit of my timeline, and I wish I remember back in the 90s, it was a great line, stay alive to 95. I haven't figured out when to go with 2013. Stay alive to 2013 doesn't rhyme very well. But
yeah, we've heard Heaven in 11. We like that better.
Heaven, actually, I have a note in front of me. I said stay alive until 2011 and real opportunities in 2013. So yes, I mean that's sort of what I said. It would be the recession sort of ends in the government parlance July. 2 years later, I believe things start to balance, especially in the key industrial markets. And then over the next 2-year period, you start in development, so in 13. But how do you recognize it? That's very interesting. In the industrial side, we could always recognize it in the 20,000 to 50,000 square foot tenants. If they were expanding, if all of a sudden you woke up and said, boy, I have no 20,000 square foot spaces left in my portfolio, you realize something has changed. And that is a great barometer, and that's why you need to stay close to your tenants, is they will lead you, to that next opportunity. And another indicator, and it's a little tougher one, I think, is when larger companies, start acquiring smaller companies or their peers. You see it in the drug companies right now. And one of the, if you were a large national player or industrial player, strong regional, I would look at the current mergers and try to figure out what facilities are going to be left standing, which facilities become obsolete, where do they need a bigger facility. I think that becomes another barometer. It's the real, if acquisitions pick up, that means money's available. If they're acquiring others, that means money's available. Logistics data, follow the logistics data, container volume, the ISM index, container shipping rates, and you can see them every week. And when they start moving upwards, something's changed. I still think there are unique opportunities in the food and staples market, with General Mills, Hershey, Kellogg, Kraft, Procter & Gamble, Kimball & Clark. And these are growth industries. We still eat. We still, I guess, make a mess we need to clean up, and they are all players in it. The other, it's a tougher barometer. It's the tenant rep brokers, and I got to admit, I've never spoken to a broker who has not said they are having good activity, whether it's in a good year or a bad year, so it's hard to use them as a barometer. But for those who you are close with, the activity is deals. They stop talking about all the showings they had and all the prospects they had, and they start talking about deals they're closing, then life has changed. And then for industrial guys, one thing that will change is the Panama Canal will open in 2014, and that's be at the worst 2015, but that's a fact. It will open, and that will change the environment. On the office side, again, it's sort of the same barometer, small tenants growing, but if I were an office person today, I'd go look for where the college grads are going, where are they living. And they like, they like to work, live, where their entertainment, all in the same area, good transportation. It's that whole work-live model. But for office guys, I go where they go, and they are the startup people. They are the creators of new businesses. It is a wonderful, exciting place to be. For big CBD office buildings, I don't know it's going to be hard to see a future, but obviously if you're anywhere, as NAP is in Virginia, near Washington, D.C., I think we're going to see an expansion of the government. We saw a lot of the expansion of the government under the last administration. It's going to continue under this administration, and I think it's a good time, though, in the buildings surrounding D.C. The other markets, state and city governments are in tough conditions, so it's hard to see a future there. Again, I'm not a strong retail person, but I don't think the retail developers have even begun to find the tunnel, whether they're willing to see a light at the end of the tunnel. I think they're still searching for that tunnel. So that's my view of the light.
Okay, well, it's dim, but we'll take what we can get. We're running a little late, but I still do want to fit in this last question that I have to you, because it has to do with how you kind of take care of yourself during all this chaos, and how you take care of your family. It's so stressful. So having gone through these things before, I'm interested to hear what kind of advice you might have.
I guess my advice would be different depending where you are in the hierarchy of the company. For the employees that are listening, the young employees of the companies, the newer employees, the ones with 1 or 2 years, it's a 2 years experience. It's a tough time, but I would focus on education, read everything you can get a hand on, network with inside and outside the business, save your money. And I know that's not what the president wants us to do, but save your money. Keep your resume fresh. Become multidimensional. If you're a quantitative person, learn development. If you're a leasing person, become a quantitative person. Try to, and if the bigger companies will allow you, or even the small ones, to work in the different departments, do it so that you can get a more well-rounded skill. Senior managers, I think, are in the worst position of them all. I mean, it is a very stressful time for them. They're going to be stuck laying off people. These are the very same people they spent years training and became, mentors to. Probably the stock options and their promotes have disappeared in value. So it's a tough time. On a personal side, take your family trip. And I'm tired of going on trips and looking at young men talking on the phone while their kids are running around at their feet. Put the phone away, put the computer away. Short trips, family trips, just be away with your family. Take that opportunity. Take the opportunity to, clean out the cobwebs in the head and come up with new ideas. At the office, open the door wider for team members and ideas and concept. Obviously, I keep telling people no screaming. People are tense. It's tense enough. We don't need to yell at anybody. Focus on strategies. Really focus on strategies and focus on them with the entire team. For owners, I mean, this is a really tough time, but it's not a time to go it alone. I'd find others to talk to, others to, conference with. Go to NAIOP. Obviously, everybody's in NAIOP who's on this phone, and talk to your peers, and honestly talk to them, and not like a lot of people, things are great and couldn't be better, but honestly find out what strategies they're implementing, how they're trying to survive, because talking through these things help, one, create ideas and help relieve the anxiety. But the key focus for the senior management is start working on those financial relationships that will carry you through the future. You may not raise much money now, but start today. Find joint venture partners. Work on that 3, 5, 10-year strategy. And my one recommendation, quite opposite from what my father said. My father said, who was a developer, as I mentioned before, believed if you were, if that first guarantee was going to wipe you out, you might as well guarantee everything. And I never quite believed that. And watching him struggle and working with him through all those struggles, that wasn't true. And you have to, as you go forward, limit your guarantees. Obviously, guarantees of completion, which your contractor can help you with, hazardous malfeasance, those you won't get rid of. But you got to try to cap a guarantee and create separate assets for your family that are not encumbered by the business. And my biggest forewarning is do not take on any undue risk just to keep everyone in the office busy. It's a prescription for failure. So that's what I would view as taking care of yourself.
Well, that's given us quite a lot to think about. We have a couple of questions that have come in, so I'll share them with you, and we'll try to wrap up in about 5 to 10 minutes. And for anybody who's on the line and can't stay, this presentation is going to be archived, and it will be available by the end of the day at the NAIOP website. So I'll give more information about that later, but it's just naop.org. The first question that is coming in is, where do you see cap rates going? Do you think the decrease in value of 40 to 50% is a result of decreasing rents and deteriorating NOI, or significantly increasing cap rates?
Well, as I said earlier, I think 35 to 40%, and CBRE has a study out, and someone else does too, and I can't think of who read offhand, that analyzes, and I read this a while ago. But I truly believe just with the change in money, the availability of financing dollars, you're going to see a 35% decline in the value of real estate. does that correlate exactly to a 35% increase in the cap rate? No, but it does mean the cap rates are going to move up and move up to and I believe the high single digits, low double digits, and probably more to the low double digits than the high single digit. But the other part of that, if the economy were still fine and the financing were to change by itself, you would see that kind of change. But if you throw in this down economy, you're looking at another 150 basis point change, and that really pushes you into that 10, 11 range cap. If you're doing Argus modeling, which is key, I think your exit cap rate cannot be below 9% at the lowest. Probably 10 would be the right place to be.
There's a kind of related financial question, a separate one that's come in. When do you think the bid-ask spread will come closer together for industrial property in Tier 1 cities?
Oh, I think we're going to get there by this summer. The current plan that's come out by Geithner to to sell assets of the banks, to have the auctions, and then to guarantee the loans and so on and so forth, which, by the way, is the same thing that the Resolution Trust did. I mean, everybody thinks that this guaranteeing of these buying of the assets is new. We did it with the Resolution Trust. I think that will start setting the floor for the value of real estate, because they'll be buying these assets for probably 30 to 40, 45% on the dollar, maybe 50 cents on the dollar. And then correspondingly, we'll know where real estate is really worth. So I think by the summer, it will start becoming very evident, and those things will close in. Excuse me.
Okay. Well, I think what we're going to have to do, unfortunately, is close the questions now. The other questions that we have not gotten to, we'll forward to our presenter, and Aaron can answer you directly via email. I really would like to thank you for your honesty, Aaron, and your willingness to share your experiences. It's especially helpful for people who haven't gone through a downturn like this. So you've given everyone a lot to consider, and thankfully some ideas that we could put in place too. As I mentioned before, anybody who wants to see the presentation again, it will be available by close of business today on the NAIOP corporate website at www.naiop.org. You just click on the large button on the front page that says Solutions Series. And the next program will air on April 29th, and you'll get an email from NAIOP corporate with details about the topic and presenter. The Solution Series are intended to be short and topical bits of information, and these are delivered as complimentary online briefings. But we want you to know that NAIOP Corporate also offers a series of 90-minute webinars, which provide you with a much more in-depth educational experience. The next full webinar actually takes place tomorrow, April 16th, at 1 o'clock Eastern Time. And the presenter is Chris Lee of CEL Associates. So if you know Chris, you know he's an optimist who always believes that every market, whether up or down, always provides unique opportunities. So in tomorrow's webinar, Chris will share ideas about strategies to take advantage in this time of incredible challenge. And plus, he's going to talk about what companies must do now to avoid financial struggles going forward. The cost of this 90-minute webinar is $125 for NAIOP members and $189 for non-members. And to register, you just go online to naiop.org/webinars. Thank you again, Aaron, and thank you all for attending our session today. Let us know how we can improve in whatever topics and presenters you'd like to hear from in future programs. Be part of the solution. Goodbye for now.